It's a strong start to the week for China markets. In early trade today, we're seeing markets in the mainland and in Hong Kong headed higher, led by the Hang Seng. They're up 0.6%. This after China held prime lending rates steady as consumption remains soft in the world's largest economy. For a closer look at that, we are joined by Francis Tan. He's Chief Strategist, Asia Indus West Wealth Management. Francis, thanks for your time this morning. So I want to start off looking at the LPR, which was kept unchanged this month's fixing. So 1 year is at 3%, 5-year LPR about 3.5. What do you make of this decision to keep rates unchanged? I mean, what is it telling you about the economic resilience of China and whether that, could influence investor sentiment in the broader region?
Certainly. I think it's also good for the PBoC to keep the LPR unchanged. Currently, at this rate, is considerably quite dovish already. Very supportive of the overall economic growth environment in China. But also the consideration of not further cutting it is such as a wait-and-see approach. I'm expecting one LPR cut, in fact, for the second half of this year, which we are already in. It's just a matter of which month it is going to be. And the key reason is that the PBoC wants to remain that option as a possible ammunition against harder tariff shocks against China. Right now, things seems to be quite comfortable in China. For the first half of this year, we have seen the latest second quarter GDP in China coming up quite strong as well. So I think they're certainly on track to, in fact, even hit the 5% average growth for 2025, although a lot of analysts are saying it should be somewhere lower than the 5% mark. So for that, I don't see a need for the PBoC to do anything, in fact, today, to do any further round of LPR cut. Like I mentioned just now, it's mainly to safeguard this option as something that they can do. Overall export numbers from China has been pretty strong as well. The only thing is that consumption remains a little bit soft. Latest retail sales numbers not up to expectations.
But that has been a persistent problem. So in a sense, everything kind of looks good for China at this point. For the rest of Asia, what we're seeing is kind of markets moving in a holding pattern. What is your read on the broader mood here, especially with big tech earnings coming up this week, which is going to be a big market mover, and also as the 1st August deadline, draws closer?
That's right. So I believe the market, as you mentioned, the holding movement, the stability, the not rushing in an upward trend right now is really because investors are now seeing at such a valuation, and we talk about the US valuations right now. I mean, if you look at stock prices right now, is almost near the 2 standard deviation of a 5-year trend channel. So investors are really keeping things on hold, not trying to add on more positions. If you have existing positions, they're keeping it there. And that also explains the pricing that we're seeing over in the US and in Asia right now. Of course, as you say, there are further earnings coming up this week, but yet everything is looming on the 1st of August. So I think really people are taking a very cautious approach right now, especially at such a valuation. In fact, at the margins, there could be investors who may be trying to take some profits off the table, especially those who went in earlier on in April due to the sell-off.
I mean, could such cautious sentiment continue? Because we are now hearing reports that Donald Trump and Xi Jinping might actually meet in October at the APEC summit. Whether or not that happens, I mean, it's a big unknown there. But until then, I mean, are we looking at the continuation of such rather muted moves until we hear something that could indicate a breakthrough? And really, how should Asian investors kind of position for that?
Sure. I mean, for most of the investors or even clients that I meet, a lot of them have this big question mark, the uncertainty, don't know what Trump will be tweeting next week or tomorrow. So I would say that we need to look beyond that there can be a lot of noise coming up from the market, coming up from Trump as well. But what Trump really wants is to showcase that the all-powerful America is out there right now, and you better accede to our requests. Basically, that's what he wants to do. But for one, I believe that at the end of the day, the economic fundamentals still remain very important for us. That is a slow-moving big elephant in the room. Anything else are basically just noise. And what I determine by looking at many of these indicators is that the global economy is indeed slowing down. Now, that's again, of course, being won by the MTI, being won by IMF, and also by the World Bank. So in this situation where we are seeing a disinflationary process and a slowing down process, any exogenous shock may move us into a deeper negative shock in terms of growth. So I would like to take this opportunity to also confirm and maintain our outlook on fixed income, because when stock markets move higher and higher by the day, hitting record highs, a lot of people generally will just, equities seems to be the only thing, and we forgot about fixed income. So we are there, we are advisors to our clients and to investors that fixed income does play an important role, especially when markets are a little bit higher like now.
Okay. I want to just take a look at Japan. You know, what we're seeing, the ruling coalition suffering its first major upper house defeat since 1955. So this is quite a significant thing there. I mean, how do you see this affecting investor sentiment? Already there's talk about a potential dip in Japanese assets. I mean, is that something that you're pricing in? And also, is there anything that could prop them up?
Yeah. So for Japan, the economy is growing quite well, especially after 2-3 decades of the lost decades, we call them. Right now, in fact, if you go look at the latest Japanese CPI numbers, there's some inflation still going on. Although the headline inflation was trending a bit lower, but the core inflation is moving higher. I was even looking at things such as your tourism arrivals, even tourism arrivals from China. That's already hitting levels pre-COVID. So expenditure in Japan from foreign visitors are strong. The only thing right now is over the last couple of weeks is the big uncertainty politically, and that certainly saw the yen trending a little bit lower. Now a little bit holding there because some form of certainty is coming in. And like all asset classes, investors, when they are very fearful, things start to trend lower until now when there's more certainty. Going forward, I still believe that at the end of the day, the bond yields in Japan will still have to trend higher because the economic fundamentals are pretty still quite robust for the whole of Japan.
Right. Okay. And Francis, that's all the time we have for today. Appreciate that. Thanks for coming in. Francis Han there, he is Chief Strategist, Asia Indus West Wealth Management.